Welcome back to our channel. We hope you'll find valuable content here. If you enjoy our channel, please remember to like, subscribe, and stay tuned for more. Let's dive in. Unveiling the art of wealth accumulation, how investors make money. Welcome to the world of investing, where the possibilities are as vast as your imagination, and the rewards can be substantial. Whether you're just starting your investment journey or looking to expand your financial horizons, understanding how investors make money is a fundamental step towards achieving your financial goals. Investing, in its essence, is a dynamic process influenced by several factors, including your investment strategy, the types of assets you choose, prevailing market conditions, and your risk tolerance. In this program, we'll delve into these facets of investing and explore the common avenues through which investors accumulate wealth. Capital gains, earning from the art of buying and selling. Imagine stepping into the world of stocks, real estate, or bonds, and emerging with a pocketful of profit. That's precisely what capital gains are all about. Investors make money by acquiring assets and later selling them at a price higher than what they initially paid. The surplus, the profit, is referred to as a capital gain. Short-term versus long-term capital gains. Now, let's take a closer look at the timeline. Capital gains can be categorized into two primary types, short-term and long-term. Short-term capital gains apply to assets held for less than a year, and they typically face a higher tax rate compared to their long-term counterparts. Consider this scenario: you bought 100 shares of a promising tech company at $50 each and sold them 6 months later for $70 per share. The profit you made from this sale, in this case, would be a short-term capital gain. If you held those shares for more than a year before selling, it would qualify as a long-term capital gain, which often enjoys more favorable tax treatment. Why understanding capital gains matters. Understanding capital gains is like having a map through the investment landscape. It's a fundamental concept that can significantly impact your financial decisions. Let's explore a few key reasons why grasping capital gains is crucial. 1. Tax implications. As mentioned earlier, the duration for which you hold an asset can affect the taxes you owe on the capital gain. Knowing how these tax rates work can help you plan your investments more efficiently and reduce your tax liability. 2. Risk and reward. Capital gains are closely tied to the risk-reward trade-off in investing. Short-term gains may offer quicker returns but often come with higher volatility and risk. Long-term gains may require more patience, but they often come with potentially lower taxes and a smoother investment journey. 3. Investment strategy. Understanding capital gains is essential for crafting your investment strategy. Depending on your goals and risk tolerance, you may choose to focus on short-term gains for rapid returns or opt for a long-term approach for greater stability. 4. Portfolio diversification. Capital gains can also guide your decisions when it comes to diversifying your investment portfolio. Balancing short-term and long-term assets can help you manage risk and potentially maximize returns. A real-world example. Let's consider a real-world example to illustrate the concept of capital gains. Suppose you invested $10,000 in a tech startup by purchasing shares at $10 each. After 3 years of growth and development, the company went public, and the share price skyrocketed to $50. At this point, you decided to sell your shares. Your initial investment, $10,000. Number of shares bought, 1,000, $10,000/$10 per share. Now, the current value of your investment, $50,000, $50 per share * 1,000 shares. The capital gain, $40,000, $50,000 to $10,000. In this scenario, you've made a $40,000 capital gain by wisely choosing to invest in a startup that experienced significant growth. Depending on the duration you held these shares, you might face varying tax rates on this gain. Understanding capital gains is just the beginning of your journey into the world of investments. As we move forward in this program, we'll explore more ways investors can earn money, the intricacies of each avenue, and how you can harness these concepts to build your financial future. So, fasten your seatbelt as we embark on this exciting journey through the world of investing. Your financial success awaits. Uncovering investment opportunities, dividends, and interest income. Welcome back to our exploration of the many avenues through which investors can earn money. In our previous segment, we delved into the world of capital gains, where profits are made through buying and selling assets. Now, we'll turn our attention to two other key sources of investment income: dividends and interest income. Dividends, your share of corporate profits. Imagine owning a piece of a thriving business and receiving a portion of its earnings as a regular payment. That's precisely what dividends are all about. When you invest in stocks of companies, some of those companies may choose to share their profits with you, the shareholder, in the form of dividends. How dividends work. Here's a simple breakdown of how dividends work. Share ownership: you become a shareholder by buying stocks of a company. The more shares you own, the more dividends you're entitled to. Profit distribution: companies distribute a portion of their profits to shareholders as dividends. This is typically done on a per-share basis. Payment schedule: dividends are paid periodically, often quarterly. However, some companies may pay them annually or semi-annually. Cash or stock: dividends can be paid in cash or additional shares of the company's stock. Cash dividends are the most common. Dividend yield: the dividend yield is the percentage of the stock's current price represented by the annual dividend payment. It's a key metric investors use to assess the income potential of a dividend-paying stock. Why dividends matter. Dividends play a crucial role in the world of investing for several reasons. 1. Steady income: for income-focused investors, dividends provide a steady stream of income, which can be especially appealing during retirement or when seeking passive income sources. 2. Long-term growth: companies that consistently pay dividends often demonstrate financial stability and growth potential. This can be an indicator of a sound investment. 3. Diversification: adding dividend-paying stocks to your portfolio can help diversify your income sources, reducing risk and providing stability in your investment returns. 4. Reinvestment: many investors choose to reinvest their dividends by buying more shares of the same stock, effectively compounding their investment over time. Real-world example of dividends. Let's consider a real-world example to illustrate dividends in action. Suppose you own 1,000 shares of a company that pays an annual dividend of $2 per share. Here's how it breaks down. Number of shares owned, 1,000. Annual dividend per share, $2. Total annual dividend income, $2,000, 1,000 shares * $2 per share. Over the course of a year, you would receive $2,000 in dividend payments from this investment. Now, let's shift our focus to another source of investment income. Interest income: profits from lending. While dividends are associated with owning shares of companies, interest income is earned by lending money. Investors who lend their money through investments in bonds, certificates of deposit, CDs, or other fixed-income securities receive interest income in return. How interest income works. Here's a simplified explanation of how interest income operates. Investment in fixed-income securities: you invest a sum of money in a fixed-income security, such as a government bond or a corporate bond. Interest rate: the bond issuer, whether it's the government or a corporation, promises to pay you interest at a specified rate, known as the coupon rate, at regular intervals. Payment schedule: interest payments are typically made semi-annually, but they can vary depending on the terms of the investment. Principal return: in addition to interest income, when the bond matures, you receive the initial investment, principal, back. Interest as income: the interest payments you receive constitute your interest income, which adds to your overall investment returns. Why interest income matters. Interest income holds its own importance in the investment world. 1. Predictable returns: fixed income securities are known for their predictability. Investors can rely on regular interest payments, making them a stable source of income. 2. Risk management. Fixed income investments are generally considered lower risk compared to stocks. They provide a way to balance the risk in a diversified portfolio. 3. Capital preservation. Some fixed income investments, such as government bonds, are highly regarded for their capital preservation attributes, making them attractive to risk-averse investors. 4. Diversification. Including fixed income securities in your investment portfolio can further diversify your income sources, reducing overall risk. A real-world example of interest income. Let's say you decide to invest $10,000 in a corporate bond with a 5% coupon rate. This bond pays interest semi-annually. Here's how your interest income would be calculated. Principal investment, $10,000. Coupon rate, 5%, 0.05 as a decimal. Annual interest income, $500, $10,000 asterisk 0.05. Semi-annual interest income, $250, $500/2. You would receive $250 in interest income every 6 months for as long as you hold the bond. At the end of the bond's term, you would also receive your initial $10,000 investment back. Understanding dividends and interest income is key to building a well-rounded investment portfolio. In our next segment, we'll continue our journey through the various avenues of investment income, exploring rental income, royalties, and business profits. So, stay tuned as we uncover more ways to grow your wealth through strategic investing. Building wealth beyond stocks and bonds, rental income, royalties, and business profits. Welcome back to our educational journey on how investors make money. In the previous segments, we explored capital gains, dividends, and interest income. Now, we venture into other avenues of wealth accumulation, rental income, royalties, and business profits. Rental income, earning from real estate. Investing in real estate can be a powerful way to diversify your income sources and build wealth over time. Rental income is a common method employed by real estate investors. How rental income works. Let's break down how rental income operates. Real estate ownership. You purchase a residential or commercial property with the intention of leasing it to tenants. Tenant agreements. Tenants pay rent to live or operate their businesses on your property. Rental agreements typically specify the rent amount, payment frequency, and lease duration. Regular income. Rental income provides a regular, often monthly, stream of cash flow. The amount you receive depends on factors such as location, property type, and demand. Expenses and maintenance. As a property owner, you are responsible for property maintenance, taxes, and other expenses. However, rental income can help offset these costs. Potential appreciation. In addition to rental income, real estate properties can appreciate in value over time, potentially increasing your overall return on investment. Why rental income matters. Rental income offers several advantages for investors. 1. Passive income. Rental properties can provide a steady stream of passive income, making them an attractive option for those seeking regular cash flow. 2. Real asset ownership. Real estate is a tangible asset, which can provide a sense of security and potential for long-term wealth accumulation. 3. Inflation hedge. Real estate often serves as a hedge against inflation. As prices rise, rental income and property values can also increase. 4. Portfolio diversification. Adding real estate to your investment portfolio can help diversify risk and balance your overall financial picture. Real-world example of rental income. Suppose you invest in a rental property, a residential apartment, for which you charge $1,500 in monthly rent. After accounting for property management fees, taxes, and maintenance, your net monthly rental income is $1,200. Over the course of a year, you would earn monthly rental income, $1,200. Annual rental income, $14,400, $1,200 * 12 months. This rental income can provide you with a consistent source of cash flow, which can be used for personal expenses, reinvested in real estate, or directed towards other investments. Royalties, earnings from intellectual property. Investors can also earn money through royalties, which come from investments in intellectual property such as patents, copyrights, or mineral rights. How royalties work. Here's an overview of how royalties function. Intellectual property ownership. You acquire ownership or licensing rights for a specific piece of intellectual property. This could be a patented invention, a copyrighted work, or mineral rights to a piece of land. Usage by others. Other entities or individuals pay you royalties in exchange for the right to use or exploit the intellectual property. This can include product sales, licensing fees, or royalties from oil and gas extraction, depending on the type of intellectual property. Royalty agreement. The terms of the royalty agreement, including payment frequency and percentage, are typically specified in a contract or licensing agreement. Why royalties matter. Royalties offer unique benefits to investors. 1. Passive income. Royalties provide a source of passive income, often without the need for active management on the part of the investor. 2. Intellectual property potential. Investing in intellectual property can lead to substantial returns if the property is in high demand or has broad commercial applications. 3. Diversification. Royalties can diversify your income sources, reducing risk in your investment portfolio. 4. Potential for long-term income. Depending on the nature of the intellectual property, royalties can provide a consistent source of income over an extended period. A real-world example of royalties. Consider the case of an author who writes a popular book. They decide to license the book's rights to a publishing company in exchange for royalties on each copy sold. The royalty agreement states that the author will receive a 10% royalty on the book's cover price for every copy sold. If the book is priced at $20, the author would earn $2 in royalties for each sale. Now, imagine the book becomes a bestseller, selling 1 million copies over the years. The author's royalties would amount to $2 million, $2 per copy * 1 million copies. This example demonstrates how royalties from intellectual property can generate substantial income for investors. Business profits, a slice of the corporate pie. Investors who own shares in private businesses or startups can earn money through their share of the company's profits. This can include dividends or distributions in the case of partnerships or limited liability companies, LLCs. How business profits work. Let's look at the mechanics of earning profits from business ownership. Ownership stake. You invest in a business and acquire an ownership stake, represented by shares, equity, or membership interest, depending on the business structure. Profit allocation. The business generates profits through its operations. These profits can result from the sale of products or services, and they may also come from investment income, such as interest or dividends. Distribution. Depending on the business's structure and operating agreement, profits may be distributed to owners in the form of dividends, partnership distributions, or distributions from an LLC. Tax considerations. The tax treatment of business profits can vary depending on the business entity and the individual's tax situation. Why business profits matter. Investing in businesses offers a unique set of benefits. 1. Ownership in growth. Owning shares in a business allows you to participate in its growth and success. As the business prospers, the value of your ownership stake can increase. 2. Potential for high returns. Successful businesses can generate significant profits and offer substantial returns to their investors. 3. Diversification. Owning shares in different businesses can provide diversification in your investment portfolio, spreading risk across various sectors. 4. Active or passive involvement. Depending on your preference, you can be actively involved in the management and decision-making of the business or take a passive role as an investor. A real-world example of business profits. Imagine you invest in a tech startup as a shareholder. Over the years, the startup experiences rapid growth and profitability. The company decides to distribute profits to its shareholders in the form of dividends. Suppose you own 1,000 shares in the startup, and the company declares a $1 dividend per share. Here's how your business profit income would be calculated. Number of shares owned, 1,000. Dividend per share, $1. Total dividend income, $1,000, 1,000 shares * $1 per share. In this scenario, you would receive $1,000 in dividend income as your share of the company's profits. Understanding rental income, royalties, and business profits expands your toolbox as an investor, allowing you to explore diverse opportunities for wealth accumulation. In our next segment, we'll dive into the world of options and derivatives trading, unveiling how investors speculate on price movements and explore the thrilling realm of financial derivatives. Stay tuned as we uncover another exciting facet of wealth creation. The art of investment, options, derivatives, and more. Welcome back to our educational journey on how investors make money. In the previous segments, we explored various avenues of wealth accumulation, including capital gains, dividends, interest income, rental income, royalties, and business profits. Now, we're diving deeper into the world of investment with a focus on options and derivatives trading, as well as interest from savings and money market accounts. Options and derivatives trading, profiting from market movements. Options and derivatives trading is a dynamic field where investors speculate on the price movements of underlying assets, such as stocks, commodities, or currencies. Profits, or losses, in these trades come from price changes in the underlying assets. How options and derivatives trading work. Let's demystify options and derivatives trading. Contractual agreements. Investors enter into contractual agreements, known as options or derivatives contracts, that derive their value from an underlying asset. These contracts can be based on various assets, including stocks, commodities, or market indexes. Speculation. Traders in the options and derivatives market make predictions about the future price movements of the underlying assets. They can take positions that benefit from rising prices, long positions, or falling prices, short positions. Leverage. Options and derivatives often allow investors to control a larger position of the underlying asset with a relatively small upfront investment. This leverage can amplify both gains and losses. Expiration. Options and derivatives contracts have expiration dates, after which they become worthless. Traders must either close their positions before expiration or exercise the contracts if they're in the money, profitable. Why options and derivatives matter. Options and derivatives trading offers several advantages and considerations. 1. Potential for high returns. The leverage inherent in these instruments can lead to substantial profits if price predictions are accurate. 2. Hedging. Investors can use options and derivatives to hedge their existing investments, protecting them from unfavorable market movements. 3. Risk management. While the potential for high returns exists, options and derivatives trading also carries a higher level of risk. It's essential for traders to have a clear understanding of these instruments and their associated risks. 4. Diversification. Options and derivatives can add diversity to an investment portfolio by providing exposure to different asset classes and strategies. Real-world example of options trading. Suppose you believe that the stock of Company X, currently trading at $50 per share, will increase in value over the next 3 months. You decide to buy a call option on Company X with a strike price of $55 and an expiration date 3 months from now. The premium, the cost of the option contract, is $3 per share, and each option contract represents 100 shares. Here's what could happen. If Company X's stock price rises above $55 before the option expires, the call option would become profitable. For instance, if the stock reaches $60, you could exercise the option, buying 100 shares at $55 and selling them at the market price of $60, resulting in a $500 profit, $60 to $55 per share * 100 shares. If the stock price remains below $55, you may choose not to exercise the option, and it would expire worthless, resulting in a loss of the premium paid, $3 per share * 100 shares. This example illustrates the potential for profit in options trading, but also the risk of losing the premium if the underlying asset's price doesn't move as expected. Interest from savings and money market accounts, growing your cash reserves. Investors can earn interest by keeping their money in savings accounts, money market accounts, or certificates of deposit offered by banks. These accounts provide a safe and relatively low-risk way to earn interest income. How interest from savings and money market accounts works. Here's how interest income from these accounts operates. Depositing funds: you deposit money into a savings account, money market account, or certificate of deposit, CD, offered by a bank. Interest rate: the bank pays you interest on the deposited funds based on an agreed-upon interest rate. Savings accounts and money market accounts often offer variable interest rates, while CDs typically offer fixed rates for a specific term. Payment frequency: interest is typically paid periodically, such as monthly or annually, depending on the terms of the account. Safety: these accounts are insured by the Federal Deposit Insurance Corporation, FDIC, in the United States, providing a level of protection for your deposits. Why interest from savings and money market accounts matters. Interest-bearing accounts have their own set of advantages. 1. Liquidity: savings accounts and money market accounts offer easy access to your funds, making them suitable for emergency savings or short-term financial goals. 2. Safety: with FDIC insurance, your deposits are protected up to certain limits, reducing the risk of loss. 3. Predictable returns: certificates of deposit, CDs, offer fixed interest rates for specified terms, providing predictability in your returns. 4. Diversification: including cash and cash equivalent investments like these accounts in your portfolio can provide liquidity and balance your overall risk. Real-world example of interest from savings accounts. Imagine you deposit $10,000 in a savings account that offers an annual interest rate of 2%. Here's how your interest income would be calculated. Principal deposit, $10,000. Annual interest rate, 2%, 0.02 as a decimal. Annual interest income, $200, $10,000 * 0.02. This means you would earn $200 in interest income over the course of a year, in addition to your initial deposit. Understanding options and derivatives trading, as well as interest income from savings and money market accounts, broadens your knowledge of investment opportunities. In our next segment, we'll wrap up our exploration by discussing realized versus unrealized gains and the importance of diversification in your investment strategy. Stay tuned as we unveil the final pieces of the investment puzzle. Realizing gains and the power of diversification. Welcome back to our comprehensive program on how investors make money and navigate the dynamic world of investments. In our final segment, we will explore the concepts of realized versus unrealized gains and emphasize the importance of diversification in your investment strategy. Realized versus unrealized gains, understanding the difference. Investors often encounter the terms realized gains and unrealized gains in the course of their investment journey. These terms describe the status of an investment's profit in relation to whether it has been sold or not. Realized gains, profits from sold investments. Realized gains are profits that have been realized or earned through the sale of an investment. These gains are the result of selling an asset, such as stocks or real estate, at a higher price than the original purchase price. Realized gains are often subject to capital gains taxes. Unrealized gains, potential profits from unsold investments. On the other hand, unrealized gains represent the increase in the value of investments that have not yet been sold. They are considered paper gains because they exist on paper but have not been converted into actual cash through a sale. Unrealized gains can fluctuate with the market and may be subject to changes in value. Why realized versus unrealized gains matter. Understanding the difference between realized and unrealized gains is essential for several reasons. 1. Tax implications. Realized gains are typically subject to taxation, while unrealized gains are not. Knowing when to sell investments to minimize tax liability is a critical aspect of financial planning. 2. Investment strategy. The decision of when to realize gains by selling an investment is a strategic choice. Investors must consider market conditions, their financial goals, and potential tax consequences. 3. Risk management. Unrealized gains are subject to market volatility. Investors should be mindful of potential market downturns that could erode unrealized gains. 4. Portfolio assessment. Monitoring both realized and unrealized gains provides a comprehensive view of your investment portfolio's performance and progress toward your financial goals. A real-world example of realized versus unrealized gains. Suppose you invested $5,000 in a technology company's stock, and its value has since appreciated to $7,000. If you decide to sell the stock at $7,000, you realize a $2,000 gain. This $2,000 is a realized gain because it has been generated by the sale of the investment. However, if you choose to hold on to the stock without selling, the $2,000 increase in its value remains unrealized until you decide to sell it. This unrealized gain can fluctuate with changes in the stock's price. The power of diversification, spreading risk for a balanced portfolio. One of the most crucial concepts in investment strategy is diversification. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, real estate, and more, to reduce risk and potentially increase overall returns. How diversification works. Diversification is based on the idea that different asset classes have different risk-return profiles. By holding a mix of assets, you aim to balance the risk in your portfolio. Here's how it works. Asset allocation. You allocate your investments across various asset classes according to your financial goals, risk tolerance, and time horizon. Risk reduction. Diversification helps mitigate the impact of poor performance in any one asset class. When one asset underperforms, others may compensate. Enhance potential returns. By spreading investments across different assets, you increase the likelihood of capturing gains in the segments of the market that are performing well. Steady growth. A diversified portfolio aims to provide more stable returns over time, reducing the potential for large losses. Why diversification matters. Diversification is a fundamental principle of prudent investing for several reasons. 1. Risk mitigation. Spreading investments across different asset classes helps reduce the impact of market volatility on your portfolio. When one asset class declines, others may remain stable or rise. 2. Protection against economic cycles. Diversification can help your portfolio weather various economic conditions. For example, bonds tend to perform well when stocks are struggling. 3. Consistent returns. A diversified portfolio is designed to deliver more consistent returns over the long term, which is crucial for meeting financial goals. 4. Customization. Diversification allows you to tailor your portfolio to align with your unique financial objectives, risk tolerance, and investment horizon. A real-world example of diversification. Let's consider a simplified example of how diversification works. Imagine you have $100,000 to invest, and you decide to split it evenly between stocks and bonds. Over the course of a year, the stock market experiences volatility, with your stock investments declining by 10%. However, your bond investments remain stable. Here's how your diversified portfolio would fare. Stock investments, minus $5,000, $50,000 initial investment * 10% decline. Bond investments, $0, no change. Total portfolio value, $95,000, $50,000 to $5,000 plus $50,000. In this example, the impact of the stock market decline is partially offset by the stability of the bond investments. This demonstrates how diversification can help protect your portfolio from significant losses. As we conclude this program on how investors make money and navigate the world of investments, remember that successful investing requires knowledge, strategy, and a long-term perspective. Whether you're building wealth through capital gains, dividends, interest income, rental income, royalties, business profits, options, or derivatives, and whether your gains are realized or unrealized, diversification remains a cornerstone of sound financial planning. Key takeaways from our program. Diversify your portfolio. Diversification is a critical strategy for managing risk and achieving long-term financial success. Spread your investments across different asset classes, industries, and geographic regions. Understand your risk tolerance. Knowing your risk tolerance is essential for making informed investment decisions. Be honest with yourself about how much risk you can comfortably tolerate. Long-term perspective. Investing is a journey, not a destination. Focus on your long-term financial goals and avoid making impulsive decisions based on short-term market fluctuations. Continuous learning. The financial markets are constantly evolving. Stay informed by reading books, attending seminars, and following reputable financial news sources. Consider seeking advice from financial professionals when needed. Asset allocation. Tailor your asset allocation to align with your investment goals. Your portfolio should reflect your objectives, time horizon, and risk tolerance. Tax efficiency. Be mindful of the tax implications of your investments. Understand the tax treatment of various assets and seek strategies to minimize tax liabilities. Risk management. Implement risk management strategies, including setting stop-loss orders for individual investments and using asset allocation to manage overall portfolio risk. Plan for the future. Don't forget about your financial future. Consider strategies such as dollar-cost averaging and automatic contributions to retirement accounts to ensure you're consistently saving and investing. Practical investment tips. Start early. The power of compounding means that the earlier you start investing, the more time your money has to grow. Even small, regular contributions can make a significant difference over time. Emergency fund. Before investing, ensure you have an emergency fund with enough money to cover at least 3 to 6 months of living expenses. This provides a safety net in case of unexpected financial challenges. Avoid emotional investing. Emotions can lead to impulsive decisions. Stick to your investment strategy and avoid making changes based on fear or greed. Dollar-cost averaging. Consider using a dollar-cost averaging strategy, where you invest a fixed amount of money at regular intervals, example, monthly or quarterly. This can help smooth out market volatility. Review and rebalance. Regularly review your investment portfolio to ensure it aligns with your goals and risk tolerance. Rebalance if necessary to maintain your desired asset allocation. Seek professional advice. If you're unsure about your investment strategy or need assistance with complex financial decisions, don't hesitate to consult a financial advisor. Stay informed. Keep up to date with financial news and market trends, but be cautious of overtrading or making impulsive decisions based on the latest headlines. The journey continues. The importance of continuous learning. Investing is not a one-time event but an ongoing process. The financial markets are dynamic and economic conditions can change rapidly. As an investor, the journey to financial success continues with continuous learning and adaptation. Consider reading books on investing, attending seminars or webinars, following respected financial blogs and news outlets, and engaging in discussions with other investors. Learning from your experiences, both successes and setbacks, is invaluable in developing your investment skills and knowledge. Remember that risk is inherent in investing, and there are no guarantees of profit. However, with a well-thought-out strategy, discipline, and a commitment to learning, you can navigate the world of investments and work toward your financial goals. Thank you for joining us on this educational journey. We hope you now have a better understanding of the various avenues through which investors can earn money and the principles that underpin successful investing. Best of luck as you embark on your own investment journey, and remember to stay informed, stay diversified, and stay focused on your financial goals.